The life insurance industry paid $63 billion in commissions in 2024. Not to policyholders, not to grieving families, to agents. That's roughly the GDP of Luxembourg, redistributed every single year inside a business where most customers have no idea what they're actually buying. And here's a number they really don't show you. If you're paying $5,000 a year for a whole life policy and your agent gets a 70% commission, that agent pocketed $3,500 in year one. Meanwhile, in most standard whole life policies, cash value doesn't build in the first year or two because of those very commissions and expenses the insurer incurred to issue the policy. You paid $5,000, your agent got $3,500, your cash value, $0. That's not an edge case. That's the standard structure, confirmed in the American Council of Life Insurers' own 2025 fact book. The story doesn't start with the product, it starts with the incentive. Today, I'm going to walk you through the math your agent almost certainly never showed you. Not because every agent is a villain, most are just working a system they were handed, but because the system itself is built to prevent one specific comparison from ever happening at your kitchen table. I'm going to show you what that comparison looks like with real dollar amounts, what it costs you over 20 to 30 years, and the one thing buried quietly in almost every whole life policy that most policyholders discover only after someone dies. There are 4 layers to this. Each one is worse than the one before it. Stay with me. Here's the frame I want you to use for this entire video. Think of whole life insurance as a 2-for-1 deal. You pay one premium, you get 2 things: a death benefit that protects your family if you die, and a cash value account that supposedly grows your money while you're alive. 2 for 1. Sounds excellent. Here's the catch with every 2-for-1 deal in history. When someone sells you 2 things for the price of one of those things is typically marked up to pay for the other. In this case, the insurance part works, it does protect your family. The investment part is where the math gets uncomfortable. And it gets especially uncomfortable when you find out what happens to that investment account the day you actually die. I'll come back to that. And every time I come back to it, the 2-for-1 deal looks a little worse than the time before. In a few minutes, I'm going to show you a number that describes what you'd have if you never bought whole life insurance at all. But first, here's why the commission structure is even more broken than you probably assume. Whole life insurance typically costs 10 to 22 times more than term for the same death benefit, according to Insurance Geek's 2026 data. Let me put flesh on that number. A 35-year-old healthy male pays about $21 a month for a $500,000 20-year term policy. That same person would pay around $550 to $700 a month for a $500,000 whole life policy. Same death benefit, same 35-year-old, same heartbeat, different product. The difference is roughly $600 a month. A 35-year-old buying $500,000 in whole life coverage pays roughly $505 more per month than a comparable term policy over 20 years. That's more than $121,000 in additional premiums. And that's before factoring in what those dollars could have earned if invested elsewhere. Now here is where the incentive structure clicks into place. Term life insurance plans pay the lowest commissions, often between 30 and 80% of the annual premiums. Insurance agents receive the highest commission rates for whole life insurance plans, often more than 100% of the total premiums for the policy's first year. So on a $400 annual term premium, your agent earns maybe $200. On a $7,000 whole life premium, a whole life policy with a $10,000 annual premium at 100% commission pays the agent $10,000 in year one. This disparity creates tension between client needs and agent income. And that's before we talk about expense allowances. Whole life insurance commission rates average about 55% of the base whole life premium. But there's a common practice of paying expense allowances on top. The idea is to compensate the agent for undertaking expenses otherwise shouldered by the insurance company. We can think of it collectively with standard commissions to arrive at a total payout, which averages across the industry to something in the neighborhood of 85% paid on the whole life premium. Expense allowances vary, and insurance agents are often under a non-disclosure agreement when receiving one. The idea behind the NDA is to prevent agents from discussing payouts with each other and negotiating higher rates. So not only is the commission high, the full picture of it is contractually obscured. You're sitting across from someone who signed a non-disclosure agreement about how they get paid, while they're advising you on how to structure your family's financial protection. I find that funny. Not funny, haha. Funny in the way that discovering the person selling you the map drew the map is funny. As a result, the premiums for permanent life insurance are often 6 to 10 times higher than premiums for term life insurance. This may lead some agents to recommend permanent policies, even if the commission percentage is the same, in part because the total commission they stand to earn is higher. There's no malice required for this to happen. Incentive is enough. Nobody needs to decide to mislead you. The structure of the payment does it automatically. Stay with me, because this next part is where the numbers start doing real damage to the whole life pitch. Here's the argument the other side always makes at this point. Tom, you're comparing apples to oranges. Term is pure death protection. Whole life builds cash value. You're getting an investment component. You can't just look at the premium difference. I want to honor that argument by actually running the math on it. Real numbers, not vibes. On average, whole life insurance policies return 3 to 5% annually, depending on insurer performance, how long you've held the policy, whether dividends are reinvested, and policy structure. Let's be generous and call it 4 to 5% for a well-run mutual company. The S&P 500's average 30-year return from January 1996 through December 2025 was 10.4%, a period that included 2 major crashes and a global pandemic. The average yearly return of the S&P 500 is 10.12% over the last 30 years, according to TradeThatSwings data through early 2026. Even if you want to be conservative and strip out taxes and inflation, the approximately 7% real figure is often the more useful benchmark for long-term planning. So the spread between a whole life cash value component and a passive index investment is roughly 5 to 7 percentage points annually, sustained over decades. That's not a gap, that's a chasm. And compounding turns chasms into canyons. Think of it this way. You could buy that $21 a month term policy and invest the $629 a month difference. Over 20 years at a 7% return, that's over $300,000 you'd accumulate, which beats the cash value you'd build in a whole life policy. Let me build this out in detail. You're 38, you buy a $500,000 whole life policy. The premium is $600 a month, $7,200 a year. Your agent shows you an illustration where optimistically, over 27 years, your projected cash value at age 65 might reach around $200,000 to $250,000. That looks like it means something. It's a number with more than 5 digits. But let's look at what the alternative scenario produces. You buy a 20-year term policy for $28 a month. You invest the remaining $572 monthly in an index fund. At 7% annual return conservative by historical standards over 27 years, that investment account holds approximately $560,000, over $500,000 versus the projected $200,000 inside the whole life policy. And critically, the $560,000 is fully yours, grows into your estate, and doesn't disappear the day you die. The cash value in the whole life policy, as we'll get to, does. By the way, hit subscribe if you like the content, otherwise YouTube's algorithm may never show you my videos again. Here's the honest confession version of what I just showed you. Knowing these numbers and actually building a system around them are 2 very different things. I built a digital book called The Exit Code. It's 8 chapters of 50 years of retirement data distilled into a mathematical framework for choosing a specific exit date from the rat race. Not someday, a specific date. 2 parts of it connect directly to what we've been covering in this video. The first is something I call the $14,000 invisible bill. It's the insurance gap that quietly destroys early retirees who leave work before Medicare eligibility at 65. Most people modeling early retirement don't account for this correctly, and it reroutes their timeline by years before they understand what happened. The second is the dynamic withdrawal method. It replaces the 4% rule with something that accounts for sequence of returns risk and the kind of cost drag we've been talking about today. If you're building a financial plan and life insurance is part of it, the withdrawal architecture matters as much as the accumulation side. You can get the exit code through the link in the description for less than what you'd spend on dinner out. Every year these numbers stay fuzzy is a year that compounds the wrong direction. Now, here's the part I promised you at the beginning. The part that most people, even financially literate people, miss completely. The part that makes the 2-for-1 deal look like something different entirely. You think the problem with whole life insurance is the low returns compared to the market. That's the obvious problem. But the actual problem, the structural one, is what happens to the cash value the day your family needs the insurance most. If you die without withdrawing or borrowing your accumulated cash value, the insurance company keeps it. Your beneficiaries receive only the death benefit, not the death benefit plus the cash value. Only the death benefit. The two accounts, the death benefit and the cash value, are not additive. They never combine. You spent decades funding an asset that exists inside the same policy document as your family's protection. And those two things are completely separate. Your family gets one, the company keeps the other. Let me slow down on that because I want it to land correctly. Say you're 58. You've had a whole life policy since you were 35. You've paid premiums for 23 years. Your cash value has grown to $180,000. Your death benefit is still $500,000. You die. Your spouse receives $500,000. And the insurance company retains the $180,000 in accumulated cash value. Not as a fee, not as a surrender charge, as a structural design feature of the product. I came across this through a conversation relayed to me about a Chicago estate attorney, 20 plus years practicing. He'd lost count of how many times he'd sat across from a surviving family member and had to explain that the savings their loved one thought they were building inside a whole life policy were not part of the inheritance. The family knew about the death benefit. They'd planned around it. The cash value came as a surprise, a $0 surprise. His summary of how the product worked: the company wins whether you live long or die young. If you die early, they pay the death benefit, priced to make a profit. If you live and build substantial cash value, they've had decades of float on your premium payments to invest at market rates. And either way, the cash value account is theirs at death. That's the 2-for-1 deal, where the restaurant keeps the second slice of pizza when you leave. This is where I want to introduce a story that runs through the rest of the video. Two brothers, Ray and Derek, both 40 years old in 2010. Ray buys a whole life policy at $600 a month based on his agent's recommendation. Derek, by chance, had an uncle who'd worked in actuarial analysis. The uncle sat Derek down, ran the numbers on a legal pad, and said, "Buy the term, invest the rest." The math isn't close. Derek did exactly that $28 a month term policy, the rest in index funds. Neither brother knows how the other is managing their finances. They're just living their lives. I'm going to tell you how this ends, but not yet. In a few minutes, I'm going to show you what the infinite banking concept gets wrong in most real-world applications. But first, I want to show you how to read a policy illustration in a way your agent never walked you through, because the illustration is where all the sleight of hand actually lives. Guaranteed values show the minimum growth built into the policy, while non-guaranteed values reflect potential dividend growth if future dividends are paid and reinvested. Reading both together gives you a complete picture of your policy's long-term potential. Here's what almost never gets mentioned. The illustrated projections on the non-guaranteed side are based on current dividend scales. These charts don't show future dividend certainty, market performance, or how interest rates may affect long-term projections, because dividends can never be guaranteed by a life insurance company. The number your agent circled and said, "This is what you'll have at 65, is a projection under favorable conditions, not a contractual commitment. When you hear a whole life agent say guaranteed growth, ask them to point to the guaranteed column, not the illustrated column. Watch how much smaller those numbers are. A traditional whole life policy built for maximum death benefit will generate cash value slowly, often zero in year one. In years 1 through 4, minimal cash value builds most of your premium covers, insurance, and fees. Years 5 through 9 see steady growth begin. Years 10 through 20 plus see accelerated growth from compound interest and potential dividend reinvestment. Which means for the first decade you own a whole life policy, you are effectively paying maximum premium for minimum financial utility on the investment side. The death benefit is active. The wealth building component is structurally suppressed. The policy is protecting the insurer's cost of acquiring you as a customer. Most of your early premiums go toward insurance costs and company fees. Whole life insurance builds cash value slowly in the first few years. Early premium payments go mostly toward the insurer's administrative costs and the cost of the death benefit, leaving little left to grow in the cash account. So for the period in your life when you probably need the most liquidity, raising kids, building career, managing a mortgage, your whole life policy is simultaneously at its least accessible and its most expensive. Now, the infinite banking crowd. I said I'd get to it, and I want to be fair to the concept before I show you where it breaks. The infinite banking concept, popularized in 2004 by Nelson Nash, argues that you can overfund a whole life policy, build up cash value, borrow against it at policy loan rates, and effectively become your own bank, lending yourself money, repaying with interest back to your policy, and repeating the cycle. The theory has genuine internal logic. The execution has 3 traps nobody mentions up front. Trap 1. The policy design matters enormously, and it almost never matches what gets sold. An overfunded whole life policy, specifically designed for maximum early cash value, heavy on paid-up additions, riders, light on base death benefit, actually pays the agent dramatically less commission. Whole life insurance commission rates average about 55% of the base whole life premium. But there's a common practice of paying expense allowances on top. The base premium generates the commission. The paid up additions rider generates almost none. So a properly designed infinite banking policy produces a fraction of the commission revenue of a standard whole life policy. Which means the policy that works best for infinite banking purposes is almost never the one being recommended to you. Trap 2, the math on the loan rates. When you borrow from your policy against the cash value, you're paying the insurer a loan interest rate that typically runs between 5 and 8%. Meanwhile, your cash value is growing, but at 3 to 5%. The cash value account earns interest typically in the range of 3 to 4%. You're borrowing at a higher rate than your collateral is growing. The spread between those two numbers is your actual cost. It's real, it's annual, and it compounds. Trap 3, the opportunity cost never disappears. Even in the optimistic infinite banking scenario, even assuming a well-designed policy, disciplined borrowing and repayment, and consistent performance, you're still comparing every dollar in that system against what those same dollars would do in a low-cost index fund. The average yearly return of the S&P 500 is 10.42% over the last 100 years, assuming dividends are reinvested. A policy delivering 5% is always competing against a passive fund delivering 10%. The gap compounds. Over 30 years, the difference between 5% and 10% on the same principle isn't a small difference. It's the difference between 2 very different retirements. A financial planner with over a decade of whole life sales on his record. I read this in a trade industry publication, eventually ran the actual numbers on his client portfolio. He found that roughly 80% of the people he'd sold whole life or infinite banking concepts to would have been better served by term insurance plus index fund contributions. He started transitioning clients. His commission income dropped by about 60% in year 1. He said it was the most ethically consistent financial decision he'd ever made in his career. He said it twice, apparently. Here's what I find genuinely interesting about the life insurance industry from a systems perspective. The US life insurance market was estimated at $1.93 trillion in 2024, and it employs some of the best actuaries and product designers alive. Those people understand compound interest, mortality tables, and risk pricing better than almost anyone. They built whole life insurance to do exactly what it says it does. The death benefit is real. The cash value grows at a guaranteed rate the money is tax deferred, and that helps money grow faster. With guaranteed, compounded, tax deferred growth, your cash value can grow to a significant sum over time. The tax advantages are real. The product itself is not a fraud. The information asymmetry is in the selling. It's in which comparison gets made and which comparison doesn't. It's in the illustration that shows the projected cash value growth curve, but not the alternative investment scenario side by side. It's in the $63 billion in commissions that buys a very particular kind of conversation, one where the 2-for-1 deal always gets presented as a deal. Let me build the case study properly so you can see your own situation reflected in it. Marcus is 38, married, 2 kids, 14 years left on a mortgage, about $200,000 in his 401k. His financial advisor, who's also a licensed insurance agent, which is not uncommon, sits him down and recommends a whole life policy, $500,000 in death benefit, monthly premium of $590. The illustrated cash value projection shows approximately $240,000 accessible at age 65. Marcus signs, "It sounds like a plan. Protection and savings, 2-for-1. 8 years pass. Marcus has paid roughly $56,600 in total premiums. He requests an in-force illustration. His current cash value, $29,000. He's put in $56,000, he can access $29,000. The rest absorbed into insurance costs, administrative fees, and the commission his agent was paid in year 1. His effective return on the cash value component, negative 30% on total premiums, paid over 8 years. The death benefit is real. If Marcus died tomorrow, his family gets $500,000. He's not unprotected. But as a wealth-building instrument over 8 years, the policy has delivered a fraction of what any passive investment would have produced. Now run the alternative. Marcus, at 38, takes a 20-year term policy for $28 a month, invests the remaining $562 monthly in an index fund. Same 8 years. Approximately 9% average annual return, conservative. His investment account, roughly $69,000 versus $29,000 inside the whole life policy, a $40,000 gap in 8 years. That gap then compounds forward. If Marcus holds the whole life policy for 22 more years to 65, his projected cash value is approximately $240,000. If instead, he surrenders the policy today, takes the $29,000 in surrender value, and continues the same $562 monthly investment for 22 more years at 9%, he ends up with north of $1.1 million. $1.1 million versus $240,000. His family inherits from the $1 million scenario. In the whole life scenario, remember, they don't inherit the cash value at all. They'd get the $500,000 death benefit, and the insurer keeps the cash. Marcus, in real life, never ran this comparison. His agent never ran it for him. The illustration showed one trajectory. It didn't show the alternative. That's the design. I imagine the conversation where someone first discovers the cash value goes to the insurer clause going something like this. Agent says, "As you can see on page 11, by year 20, you've built up a substantial reserve." Client says, "Great. And when I die, that reserve passes to my family on top of the death benefit?" Agent says, "Actually, the policy pays the death benefit to your beneficiaries, and the company retains the accumulated cash value." Long silence. Client says, "So the savings account, that's mine, but it's also theirs?" Agent glances at the exit. The infinite banking crowd will respond to this at some point by saying, "I'm ignoring the tax advantages." They're right that there are tax advantages to whole life. You know what else has tax advantages? A Roth IRA, a 401k, a health savings account. The tax benefit of a whole life policy is real, and it has been priced into the premium you pay for it. There is no free lunch in finance. There are just very expensive lunches that get presented as complimentary. Let me finish Ray and Derek's story. Ray and Derek are both 75 now. Ray has been paying $600 a month into his whole life policy since age 40, 35 years. His total premium payments, $252,000. His current cash value, approximately $220,000 accessible. He's accessible to less than he paid in before accounting for what that money could have grown to elsewhere. The death benefit, which his family will receive, is $500,000. Ray doesn't think of himself as having made a bad decision. The policy did what it said it would do. He's just never seen the comparison. Derek is 75 and doesn't have a whole life policy. He had a term policy from 40 to 60 that cost him $28 a month and expired worthlessly. He outlived it, which was the plan. For 35 years, he invested $572 a month in index funds at approximately 9% average annual return. His portfolio, just over $1.3 million. His family inherits from that portfolio. There's no cash value goes to the insurer clause in an index fund account. Ray's $22,000 gap against his own contributions looks small. Derek's advantage over Ray is more than $1 million. On the same monthly payment for the same 35 years, starting from the same kitchen table, just with one different number drawn on a legal pad by an uncle who happened to understand actuarial math. Here are 3 things you do right now. These are not generic. They are specific to what we covered. 1. If you have a whole life policy, call your insurer this week and request an in-force illustration. Ask them specifically for the guaranteed values column, not the projected or illustrated column. Look at how much cash value you've built versus how much you've paid in total premiums over the policy's life. Calculate your effective return on the cash value component alone. That number tells you where you actually stand, stripped of projection optimism. 2, before you make any decision about keeping or surrendering the policy, run the term plus invest the difference scenario for your exact remaining investment horizon. Use the 7% conservative return assumption. Compare the output to the projected cash value in your illustration at the same future date. Put both numbers on the same page. Your agent should have shown you this comparison at the point of sale. If they didn't, you now know why. 3. If anyone ever tries to sell you whole life insurance as a primary wealth building vehicle, ask this one question before you sign. If I die with this policy in force and significant cash value accumulated, does my family receive the death benefit plus the cash value, or only the death benefit? The quality of the answer and whether they hesitate tells you everything about how the rest of the conversation has been calibrated. Lazy investing built more fortune than crypto memes. The industry paid $63 billion last year to people having conversations where that question never came up. The product works exactly as designed. The math, however, works for you only if someone was kind enough to show you both sides of the 2-for-1 deal.